Hello, all. Thank you for joining us today. Hope you all saw the Republic Day parade in New Delhi. Such a soulful scene to witness. Today, we have with us Mr. Ganesh, Associate Vice President, PMS, who will be taking you through the Solitaire presentation. Without wasting any more time, let me pass on the podium to him. Thank you.
Thank you, Tarun. Good afternoon, everyone. Thank you for joining us today on a Saturday. So, the year that was, right, 2023 has been an eventful year for all of us for a lot of reasons, right? We've seen our portfolios go up significantly, and I mean, all of us, very honestly, made a good amount of money, right? So, today we need to look back and see how this amount of or how this uh, Tarun, there is a question from the audience saying there's no audio. Is the audio clear?
Yes, sir, the audio is clear from my side. Yeah, it's clear, sir.
Okay. Ramani sir, could you check at your end if there is any audio distortion? Thank you, sir, so that we can continue. So as I was saying, it's in 2023, things have been very, very eventful for a lot of us, right? We saw our portfolios go up. We saw a lot of our stocks doing well, but it is important to see where this all this comes from, right? And where Solitaire is placed and how Solitaire did in 2023 and how we positioned ourselves to be part of the whole thing is what we are going to be looking at in this presentation. So if you going into the presentation, if you look at the first question, how was 2023 for India and the Indian markets? We all know how Indian market capitalization topped $4 trillion recently, right? In December, right? 2023 was known for a lot of things, but the Indian markets, they surpassed it all, right? I mean, towards the end of the year, you can see markets going up to their all-time highs, and everyone is happy today, right? And this has come for the right reasons because of India's resilience amongst the global turbulence, right? If you look at global trades or global geopolitical tensions or inflation, and where the financial conditions have become more tightened today, now it's expected to ease, which is why you're seeing the rally in the US. But when you compare it to how the Indian markets have behaved on a macro level, we are positioned much better than the rest of the world. And that is exactly what is reflecting in our markets as well. But then what we need to sit down and look back, because most of the time what we as investors, right, a common investor, what he or she does is as long as the returns come, they're happy, right? But whether it's going to be positive or negative, it's going on the upside or the downside, we need to know where this comes from. This definitely has come from capacity utilization, more investment-led activities going up with balance sheets getting healthier and public capex improving, right? And consumption, though it is not very robust today, it was going to, I mean, you can see shoots of consumption pick up in rurals, right? And if you look at consumption in the urban segment, that's what has supported most of the growth this year, right? So tomorrow, where do we go from here, right? That's what we're going to be looking at. If you look at credit growth, that has been robust, and it still continues to be robust with respect to GST revenue. Everything is going good for us on a macro indicator level. And infrastructure growth is a part of L&T's presentation. Its growth is on a song. You can see that they've completed their successful first buyback as well. So you don't see this from a industry behemoth showing. I mean, because Larsen and Toubro is a company which is making inroads in a lot of ways within the country and outside the country as well, right? So if you look at their presentation, they're very upbeat about infrastructure growth in the country, and that the numbers are there for you to see. Nifty earnings estimates as well, they're all good. I mean, expectation has been revised if you look at the estimates beyond a point, right? If you look at the chart in this case, uh, between 2024 expectation at one point of time has moved up, right? So what this chart shows is that at one point of time, maybe in 2020 or 2021, the EPS estimates for 2023 or 2024 were a little bit muted. But then beyond a point, as evidence started coming on business and evidence started coming on growth, right? The estimates have been moved up. So they've been pretty much stable. So with respect to earnings, we have been stable. But what we always need to look for in the markets is valuations, right? which is why your net FII inflows is yet to gain steam. This is as of November, December data, and you see if you look at January data also, FIIs have been pulling out, right? Primarily because of the reason that the markets do not provide a decent valuations for them to enter, right? Because FIIs, when they come in big, right? And they want a good enough space where they can pool their money in and buy. But that kind of a valuation is not conducive, or rather, those favorable valuations are not available in India as of today. So this is where we stand. So you look at infrastructure growth, you look at GDP growth, you look at domestic activity, it's all very robust, right? But then why don't FIS come today? It's primarily because of valuations, which we will be tackling, and how Solitaire has a bottom-up approach to all this is what you'll be seeing in the presentation. If you look at how 2023 was for Solitaire. Just to give you a brief of how our AUM has grown over a period of time, we want to thank all our investors and all our well-wishers and everyone who's made this possible, right? We recently hit 857, we are inching close to 900 and hopefully close to 1,000 crores before the end of the fiscal year. The reason why we've been able to gather this AUM is because Solitaire is a product that addresses a wide set of investors' requirements on a very holistic basis, right? In terms of returns, we've done well. That is one part of it. But then, if investors wanted only returns, right, the highest return making fund or any mutual fund would gather the most AUM. But that is not the case. We all know that, right? People want a risk adjusted product, or people want a product that is aligned to their expectation and does not give them surprises, right? That is exactly what Solitaire intends to do, because what we say is what we do, and what you can expect is something that is set within the first conversation itself, and that is what Solitaire has done time and again right from its inception. And this is something that we would want to put out very happily, right? All our 3 year plus client portfolios, which comes to around 50 clients when we started off in since we started off in August 2019, right? It's been close to 4.5 years right now. It's going to be five, right? More than 4.5 years. So those people who stayed the course with us for more than 3 years, they saw their portfolios outperform the benchmark by at least 4.7%, which is close to 5%, where you see the average benchmark performance range between this time is around 20 to 25%, right? So you can see that there is a good level of value enhancement. But then what we need to actually understand in this case is these are the peak of the bull market, right? This, you can see valuations being stretched to one level on the upside. So we need to keep our expectations very, very decent. That we've outperformed the benchmark is one point of it, but we always want to anchor our Solitaire investors' expectations to around 15%, which is what we keep reiterating once again, right? So when we outperform the bonus, or rather the both of us, both the client and both the client and Solitaire would be happy, right? But our expectation is lies somewhere between 6 to 7% or 6 to 8% post after inflation, right? So over and above inflation, if we are able to generate 6 to 8%, that is something that we would be happy with. But again, this is something that we would need to keep note of, because this is a very, very special moment for these 50 clients. The amount of money that they would have made over a period of time just by staying invested with us and just by keeping their trust with us is immense, right? The value that is created for them is immense, and we would want to put it out to our future investors as well. And there's a stock level value enhancement, right? So 2023 has been a mixed bag of emotions, right? There are a lot of decisions that were involved, and they're not straight decisions as well. If you look at the top quadrant, right, it's an IT company that we bought in 2022, right? If you look at 23, the activity levels in terms of buying were restricted to the first half only. After the first half, that is after June 2023, it was pretty much a subdued activity level because of valuations. But for us to see the fruit, for us to see these ideas bearing fruit, was a brilliant phase between June 2023 till now, right? That's what you're seeing in these quadrants. If you look at an IT company, which is in the first quadrant, right from the beginning, the fundamentals have been going up. I mean, fundamentals have been very positive, and that straight away reflected in the stock price as well. But if you look at the second quadrant, which is the industrial consumables company, it is a clear case of patience being rewarded, right? We bought this company in September 2019, so it's been 4.5 years, close to 4.5 years since we were holding it. So we bought it for our first client, and pretty much our last client as well, or rather, not exactly the last client, but till 2022, right? So if you look at this stock, it is being rewarding for most investors and for the fund manager because fund manager's primary requirement, right, is to buy a specific idea that he has arrived at for all his investors. So our intention is to do that, right? For another person who comes in late or a person who comes in early should not be denied of an opportunity just because of their late or early entry. And this is a stock that gave us the opportunity tremendously, right? For a period of 3 years, it gave us the opportunity to accumulate. And in the fourth year, just as a reward for our conviction, it went up around 3 times or 4 times, right? That's the average. I mean, if you look at the CAGR on a CAGR basis over a period of 4.5 years, it's delivered around 36%, right? This is purely, and see, one point is you can have one stock which goes up 2x or 3x in 1 year, but you can have a stock which doesn't do anything for 2, 3 years, so that the type of value that you create for a wide set of investors in those kind of stocks is what we typically look for, right? Because in stocks that go up suddenly after we start buying, those are the stocks that we are too overjoyed about. I mean, the gains are there for us to see, but then we are more happy with a stock which doesn't do much until we accumulate for all our investors and then gives us the reward. So, a second quadrant is something that as a result of our the patience of all our investors and our own fundamental thesis that has been worked that has actually worked out over a period of time, which has been very, very rewarding for us. The same thing, if you look at the third quadrant, which is the general insurance company, it's a current underdog, right? Nobody is looking at insurance today, and it's a current underdog, and the fundamentals have been going up since the time we bought, but then the stock price has been flat. Usually, what happens with these kind of companies is they tend to give out whatever they expect. So let's say we buy the company with an expectation of a forward IRR of 15 or 16 or 17%. These companies tend to, for whatever reasons, right? If, for whatever macro related reasons or micro related reasons or any domestic reason also, right? uh, they don't go up, right? But most of the time, if your conviction is correct, if your thesis is going right, and if the company is doing all these things properly, right, if the company's management is good enough, the company's fundamentals are still intact, more often than not, the second or the third year or the fourth year, it should return your waiting, or rather, it should reward you for your patience, just like how it rewarded in the second quadrant, which is your industrial consumables company. So, whether this general insurance company is one of the most profitable insurance company in this segment, and it's a current underdog. So we still have a lot of conviction in it. So this is somewhere. So this is a quadrant which we are predominantly looking at today because these can be current underdogs today, but this is where we place our money in solitaire with respect to solitaire today. If you look at fourth quadrant, right, this is something that we would want to tell ourselves to avoid from the next time because, I mean, you can't completely avoid non-performers in terms of fundamentals, right? Because this has been a non-performer in terms of fundamentals, but then the stock price has actually gone up, right? But we do not want a company that we have in our portfolio for which the stock price goes up randomly without any attribution of its fundamentals going up, right? This is an automobile company that we bought in 2021 December, and since the time we bought, our conviction or the thesis on which we built this company, right? The management of the company never satisfied or fulfilled those assumptions that we had on our thesis, right? So not exactly assumptions, but then with respect to its history and with respect to the company's strategic position in the market, we had to take a call initially in 2021 that we want to buy this company, but then the company never satisfied us on other parameters during their quarterly results or their AGMs, where they were pretty evasive of certain things that they said once, and then they didn't do the other thing when the time came for it, right? So this has always been a non-performer in terms of fundamentals. But then if you look at the stock rate, it still went up. At one point of time, we thought, this company this is a huge red flag for a company which says one thing but does another thing. So we got out. So this 2023 has been the reason why we put out this quadrant is it's been a very, very decisive year. We need to see what we need to hold on to. We need to see what we need to come out of. We need to see what we need to add more of, right? These four companies are I mean, these four companies represent all these decisions that we take in 2023 because you can't ideally have a very linear approach to all this, right? When you buy something, it does not mean that you buy everything around you. And when you sell something, it doesn't mean that you sell everything around you. So there's a specific time to do each and every activity, and buy and sell are independent activities. And these four quadrants represent the entirety of the decisions that we did in 2023, right? That's typically what we want to show, and the amount of divergence that you see in stocks, right? Because everything won't work out the same way. Some stocks will not work for 3, 4 years, and then on the fifth year they'll move up. And some stocks move up immediately after you buy. Some stocks, even if they move up, they don't perform fundamentally. So there are different ways that an analyst or a portfolio manager has to look at your portfolio before he takes a specific decision. That's what this quarter tries to tell you. And this is a bottom-up approach coming into action in 2023, right? If you look at 2023, like I said, beyond a point, we focused more on inactivity than activity, right? Because most of us confuse activity with productivity, but that is not something that we would ideally look at, or rather we do not subscribe to that kind of thinking, because as we always say, solitaire is going to be one of the most boring portfolios that you can see in your wealth creation journey, because our intention is to hold on to stocks and stop buying these stocks when valuations reach insane levels or when valuations are overheated, right? If you look at this specific household FMCG company, we started buying it close to 2022, and then we bought more, 2022 May, and then we bought more at the end of 2022 by reducing our initial position to 2% because of the valuations going up. And we entirely stopped buying close to June, end of June, or mid of July, right? So that's when you see our activity levels going softer on an overall level as well, right? If you look at the 2023 period, it's been a waiting period mostly, right? Whether it's going to be for correction or whether it's going to be for getting stocks at the right valuations, it's been more of a waiting period and looking at our stocks doing well, right? So this is what we've typically done. And 2024, what is in store? That is what this presentation is going to talk about further. Will timing the market work in 2024? Okay, this is a topic that we wanted to specifically address because a lot of our investors have this question, right? In 2024, is it wise to wait for the markets to correct and then enter, or will 2024 closer to the elections, will market face a lot of volatility at that point of time? Should I add more? All that, all those questions, as any investor, right? Not just our investors. I mean, for us, right? For any common investor, even us, right? We need to know if 2024 will give all that. But honestly, market has a way of surprising all of us, no matter who you are, right? So you will never know when market will throw you surprises. So what you can do, you can only control the controllable, right? You can be prepared. You can make sure that you're not on the wrong side of the trade. You can make sure that you're not playing momentum in 2024. So you can, at one point of time, say that, okay, I will stay invested, but I stay invested in the right names. And how much should I deploy at this point of time? These are the decisions that you predominantly should take in 2024 to make sure your positioning is correct. But let's look at certain behavioral aspects of timing the market in the forthcoming slides. If you look at this slide, right, it shows, does timing the market actually work? So this is Bank of America's data for different periods, right, from different decades, right? If you look at the decade between 1920 to 1930, the price return of S&P 500 has been minus 42%, right? The price return, the actual return. If you exclude the worst 10 days per decade, it's been 39%. So it's a very good number, right? So, but how hard or how easy would it be for you to exclude the worst 10 days of that decade, right? There's 10 years. That decade has 10 years. That 10 years has 365, or rather, let's say 250 working days, right? Trading days. So 250 into 10 would give you 2,500 trading days. Out of this 2,500 trading days, you want to exclude the worst 10 days to end up getting a price return of 39%. It definitely is not easy, and definitely not possible for you to do that accurately to get this 39% number at all, right? So what you can see is this 1920 to 1930 decade has been so. You can see the price return being negative. If you look at the average, right? If you look at the average price return, let's say you had stayed invested in the first column, right? In the first column, if you look at, if you had stayed just invested between 1930 to 2020, the price return at different points of time, right? You would have seen I mean, without doing anything to your portfolio, that is, right? You don't want to pull out and then come in at a lower point, or you don't want to pull out at a high and then come in at a low. All that you don't try to time. But if you didn't do all that from 1930 to 2020, what you would have seen is that your portfolio going up by 278 times, basically 177 point. I mean, 17,715% is that, right? So your portfolio has actually gone up by 17,715%, right? Which is a heavy number, but over a period of 90 years. But the important thing to look in this case is that if you exclude the 10 days, the best 10 days per decade. See, in the previous example, the initial example that we saw 1930 decade having the excluding the worst 10 decades per, I mean, worst 10 days per decade, which is 39%. But if you exclude the best 10 days per decade, which gives you minus 79% on your portfolio, and if you keep doing that, right, so it is as hard as choosing the worst 10 days per decade. I mean, whether you choose the best 10 days per decade or worst 10 days per decade, they are equally hard, right? If you do all that, what you will end up getting is a meager return of 28% over a period of 90 years, right? That is what you're looking at. So what this tells you on a very simplistic basis is that this, if you don't do anything to your portfolio despite market up moves or down moves, or rather, if you are not affected by market up moves or down moves, what you tend to get is an average return, which is much better than trying to time the market. Because you when trying to time the market, you tend to exclude the one of the best days during the decade. Let's say in 2023 March, or right, 2023 April, we thought that this is going to go down further. The markets are going to go down further. Think about those investors who pulled out money at that point of time and waited for a lower point to enter. They would have missed a huge rally between these 6, 7 months, right? So this is what we typically say. If you stay invested, right? If you stay invested with the right kind of stocks, if you stay invested with the right kind of portfolio managers or advisors who are not going to missell products and not going to buy the wrong things for you, then you're good enough by making, I mean, you would make good enough returns over a period of time. That's what this global data suggests. But let's also look at how India's data puts this point out, right? If you look at India's unluckiest investor, this is a data that is pulled out by Ms. Monica Hallan on India's unluckiest investor, right? So this is an investor who has invested 1 lakh at each year's Sensex size, right? Each year from 1992 to 2023, this investor has invested 1 lakh each year at Sensex high, right? Let's say Sensex was 2023, high was around 21,000, 22,000. They had invested 1 lakh, and like the same way they've invested at the Sensex high since 2000, since 1992, right? So this is a period. This is a sum of 30 lakhs which has been invested over a period of 30 years at different points of time. If you look at their 30-year average CAGR, right, it comes to around 12%, which is again a very good return for you to be generating over a period of 30 years. That's a humongous return, right? Think about how your money has compounded. Your 30 lakhs, which has been invested not at once, it has been invested as 1 lakh, 1 lakh, 1 lakh each year for a period of 30 years, has grown to a corpus of 2.5 crores, right? So, and if you look at the number of years that the portfolio was down by 50% of more, it's 2 times between this period for a period of 30 years. So, despite your portfolio being down by 50% of more, twice during this 30-year period, your portfolio has grown from 30 to 2.5 crores, and not directly. It's by just investing 1 lakh on each year at the Sensex size. That's the most important point, right? So even if you were the unluckiest investor in India, if you had kept your investing behavior right, if you had kept holding on to your stocks, if you had kept holding on to the index for a 30-year period, you would have generated a CAGR of 12%, where a significant amount of money you would have gotten in your hand by now, which is around 2.5 crores after investing 30 lakhs over a period of 30 years. This reiterates just one thing, right? The most important aspect of investing is behavior. It's not because behavior can deliver performance that you will not realize today. Because for us, most of us have a very short-sighted view of investing, right? We want to put in money today and get the returns tomorrow. But usually, investing time invested into your investing, right? That's what is going to show you your rewards. That's what is going to reward you that's what is going to reward you in the long term, right? As long as you stay in the right kind of stocks. This doesn't say that, you try to buy every other stock and ensure that this goes. But as long as you stay with the right kind of stocks, you are there, right? Pretty much if you have your own trust in the markets, if you have your behavior set right over a period of time, over a significant period of time, you're bound to make good amount of money. Okay, now we've spoken about timing the market versus buy. So we've talked about timing the market, right? So when we say timing the market, we usually say today we have an initial deployment of around 30-35% in solitaire, right? Which I will get to in the next few slides. So when we say that, uh, people tend to ask us, aren't you timing the market? Why don't you go 100% and buy immediately today itself, right? That's a very, very valid question, because when you look at it on an index level, that's a different thing. But when you resort to bottom level stock picking, it's a different thing, right? So when you resort to index level investing, you end up, even when you're buying it at the highs, and even if you're very disciplined by putting a lakh every year, you end up getting a 12% CAGR. And if you're able to tweak your behavior a little bit better and add some valuation comfort also at that point of time, think about the experience that you would get over a period of time. This is exactly what we want to show. This is a global example, which is Walmart Inc.'s 50-year price chart. This is how timing the market versus buying, right, that edge lies. This is where the edge lies, right? If you look at its performance from 1973 to 1999, right, or till 2000, the stock has gone up by 1400 times. That's a humongous return that it has generated for its investors who started from 1973. And even when they got in, let's say in 1977 or 1980, they would have still made a lot of money. But if you look at the period from 2000 to 2023, right, the rest of the 23-year period. So the initial 27-year period, the stock went up by 1400 times. But from 2000 to 2023, the other 23-year period of the overall 50-year period, the stock went up by a meager 2x, right? Which is much less than what the company delivered. So the company, let's say, because in this case, right, usually the question is, see, the company is doing well, the revenue is growing well, the PAT is growing well, the company is one of the top guys in the world, right? Walmart is one of the top guys in the world in the relevant industry that they operate in. So the question is, everything is good, then why not invest? But and this is the answer, because the even from the period from 2000 to 2023, nothing happened to their fundamentals. They're still one of the best companies in the world with the way they manage money, as with the way they manage their finances and their revenue and the overall business. Right, they're still top notch. But then the entry valuations for investors who got in 2020, I mean 2000. It's been a very, very dry patch, or rather, they've made less than what they could have done by just investing in a debt instrument or an S&P BSE 500 index fund, right? So what this typically shows is, despite the company being a great company, having great fundamentals, your entry valuations are very, very important. You can be the best company in India, can be the best company in the world. Unless you buy them at the right price, unless you buy the company at the right price, you're not going to make money. Walmart is a very, very good example, global example for you to, for us to see the numbers. I mean, there are domestic examples as well, right? If you've gotten in, let's say, of certain FMCG companies at the wrong valuations, you would have seen time correction. You would have seen a very horrid time correction going through your portfolio, right? You would have seen other portfolios go up, or other substandard names in terms of fundamentals go up, but still you wouldn't have seen your portfolio go up, because despite staying quality names, because you bought that quality at the wrong price. And solitaire, how does this happen in solitaire then versus now? Nifty 50 today, we all know. I mean, though there have been the first month of the year has not been very good for the Nifty, you can still see that it's still at a it's still at its highs, right? Markets have been very rewarding. Everyone is happy about markets, though these corrections would be there. They're still upbeat. Market is still upbeat about a lot of things, right? So we're all happy. That is one thing. But what solitaire does at these points of time is what we were talking about, right? At solitaire at market highs. If you look at solitaires at different market highs in 2021 October or December 2022, our cash deployments would have been totally different from our cash deployment today. So the simplistic understanding that, let's say it goes to Nifty goes to a high, then we reduce our cash levels to 30, or reduce our cash levels or increase our cash levels to 60, 70%. It doesn't work that way, right? If you can see that the cash levels that we have today are significantly more than what we had at previous Nifty highs. This tells you just one thing about how bottom up our approach is, right? Today, if you look at the market, we feel the good segment of the market is pretty overvalued, and there is very little value that you can potentially look at today. But again, this again comes with a question, right? If you say that there is no value in a lot of pockets in the market, is this the right time to start? The only thing that we have to tell our prospects and our investors is that see, most of the time, market catches you when you are unaware about what you have to do at that point of time, right? In 2020, though in hindsight, we can say March 2020, when COVID happened, none of us were, even people who had cash in their balance sheets weren't able to take a call because let's face it, as humans, we have our own emotions playing a lot of things in our mind, right? We cannot take decisions rationally when we are pushed to an corner because COVID was a time which was a black swan event for the entire world, right? When people actually thought whether, or rather had a doubt whether we would survive or not, right? But that being said, our behavior didn't change even in March 2023 or April 2023 when markets gave a good amount of correction. At that point of time, when our investors calls went from our advisors to our investors to add more money, and people who participated around that point of time, right? They could make a good amount of money in the from the rest of the year because their entry valuations are right. So why we are telling you this is that today the valuations are expensive. Today, this is where we are at. We are deploying only 35% of your money. But then when this opportunity comes tomorrow, you may not be ready at that point of time because you may not all have all the facts. But then being ready is an integral part of your investing journey because it is your portfolio manager who looks at his own. I mean, because this is our bread and butter, right? From 9:15 to 3:30, this is what we keep looking at, and we have a very strong vigil on stocks that we want to buy for our investors. So your pipeline is definitely robust, but then when it will happen is anybody's guess. But then if you ask us who will be ready, I mean, a person whose bread and butter is just this, or a person whose core activity is different, we would always go with the person whose bread and butter is investing, right? So if your portfolio manager is ready with the ideas, your positioning has to be in such a way that you give them the required ammo or required resources to deploy when the time comes. That is where we are at today. This 64% cash is not unused or underutilized or dead money or idle money. It is dry powder that we would want to use in case of a market correction. And just to give a current performance of solitaire portfolios that started at market highs, when the questioning for, I mean, generally, when people think, right, even if they're okay with us deploying only 30-35% today and deploying the cash later, they always have a question on how we are going to perform because we are getting in at the highs of the market, right? This is just to give you how portfolios which started at previous market highs in 2021 and 2022 have behaved. The thing is, outperformance against the benchmark is not something that we gun for, but as a consequence of our process, this has come out. So this has been extremely rewarding for people who've trusted us with their money, and the intention is to give a good enough experience, a decent experience for investors in the future as well, right? So this outperformance is just to show that despite clients entering at different levels of the market, our intention is not to deploy their money immediately. Their deployment will be very phased according to the valuations prevailing in the market at different points of time. And typically our philosophy, right? You usually we keep reiterating this again and again. It's your great investment, which is your combination of strong fundamentals and attractive valuations, right? If you look at this checklist, you can see good corporate governance, you can see leadership teams, you can see industry leaders, and high growth ratios or low leverage. All this is something that we typically keep talking about again and again and again. But what we tend to mostly miss out as investors, right, is buying these stocks at reasonable valuations. Anything at the top five that we keep telling our investors, right? If you play momentum and if you play it on, and if you're caught on the wrong side of the trade, you end up losing money, and you don't tend to make that money for a significant period of time if your entry valuations go wrong go completely wrong. So we do not want to go completely wrong. So there's a difference there's a difference between going extremely right or not going wrong, right? We would want to be in the not going wrong category because that has actually worked very well for us. As a consequence of our process, we have actually gone beyond those people who tried to go right and not just try to not be wrong, right? So that is the kind of thing that we advocate. We do not want to be wrong. We do not want to be caught on the wrong side of the trade. So our entry valuations are very, very important to us. Along with strong fundamentals, that is something that we need to tick off as investors before we buy a specific idea for you. And typical long-term investment success is your riding your winners and selling your losers based on your fundamentals, right? We saw this quadrant where we saw multiple winners in those three quadrants. Some winners had won immediately, some winners took time to win, some winners are still winning, and some losers we've sold. Right? This is typically what we advocate for our investors because you're going to have winners, you're going to have big winners, you're going to have multiple performers, optimum performers, and definitely, as the law of probability states, you're going to have losers. It is upon us to identify these losers soon enough before they hurt your portfolio. Because we have a strong vigil on the fundamentals of these companies. And idea maintenance is something that we take very, very seriously more than idea generation. Because idea generation is one part, we generate the idea. But then why should that idea be part of the portfolio is something that we keep telling ourselves or keep repeating to ourselves and keep convincing ourselves on a daily basis. So if we look at an idea, we reiterate our thesis once again, once again, once again. Every time there's an evidence that this thesis is not working out with a specific stock, then we tend to sell that loser. That's how you must read this long-term investment success. It's typically a combination of these two and some portfolio quants for you. The intention of Solitaire is not to get into, like I said, not to get into high leverage companies or companies where the balance sheet is a little dicey. Because in an interest rate environment, high interest rate environment today, though it is softening a bit, we do not really know where things can lead. We usually play on the back foot in during these kind of times because you see that when your balance sheet is not clean, right? When your balance sheet is too cluttered with external capital funding your business, with external capital trying to move your business, you're not self-sustainable. So Solitaire typically looks at companies which are more self-sustainable, which can run on internal accruals more than external capital, because these are the companies that are going to be rewarding when the tide turns. When global recovery happens, then that's a different thing. But then if we do not want to be caught on the wrong side of the trade if let's say the inflation data is a little bit different than what we expect. You can see that this will hurt the companies which have a very, very highly leveraged balance sheet, much more than companies which have a deleveraged or a low leveraged balance sheet, right? That's typically where we want to play. And it's a balanced sector composition that we see as of 31st December 2023. And what we would want to reiterate in this from this slide is that this is the combination, or rather, this is the summation of all the portfolios put together. So today you come in, you won't have the same sector composition that you see today because this is the summation or the average of all portfolios put together. So today we would not be buyers in capital goods, right? We would not be buyers in construction. We may be buyers in, let's say, entertainment or financial services. Selectively, we may be buyers. We can be buyers in IT today, selectively again, right? Depends on case to case basis, which is why your Solitaire portfolio is going to be extremely customized and your sector composition will get built over a period of time. Right beyond a point, once we start using up the remaining cash in your portfolio, you can see the opportunities come during different points in the market, and that's when your portfolio gets built because we are in no hurry to deploy all your money. We do not have a mandate like mutual funds do, and we can also, just for a hypothetical case, go 100% cash also on your portfolio. But then it even if you go 100% of cash, we would ask our investors to stay invested with us because at one point of time, this 100% of cash it would be considered as dry powder to be used when the market opportunities come in your favor, right? So this is a hypothetical case. 100% of cash is not going to happen because we still have opportunities in the market where we are buyers. And once you see more opportunities, you will get your portfolios get filled up with different sectors and different with giving you a very, very balanced sector composition in your portfolio. And some Solitaire quants for you. 857 crores is what we are at in terms of AUM today. And this, if you look at their the debt-free companies is weight, right? Like we had mentioned, it's around 83% that we have debt-free companies. And if you look at MNC companies are companies which do not require a lot of external capital to function because they have everything set by their parent company, which is a global leader, probably, right? And they have huge, robust cash flows. They have a brand associated to themselves. And these are companies which can be smaller companies as well. There are smaller companies operating within a niche segment, which are MNC companies by themselves. And these are top-notch quality companies which will deliver cash flows or which will deliver, and they're dividend paying companies as well. So these are the companies that we typically hold in Solitaire, and all this with a portfolio beta of 0.75. When the market is operating at a beta of 1, where I mean, as against the market, only that we compare the portfolio's volatility, right? When you compare market's volatility and Solitaire's volatility, right? The risk-adjusted returns or the risk-adjusted performance is going to be immensely rewarding in terms of a Solitaire shareholder as of today versus what the what the investor has done in terms of market returns and some market cap classification today with respect to large cap, mid cap, and small cap. You can see a good amount of skewness towards mid and small cap today because of the recent rally that has taken these mid and small caps up. But today, let's say you come to us with your money and ask us to invest in a new solitaire portfolio for you. This bifurcation would be very different because we today are very picky about small caps. We do not want to buy because we do not want to be caught on the wrong side of the trade. Because when capitulation happens, it happens across, right? When money goes out from the market, it goes out from all buckets. It is not just from one specific bucket, or market doesn't look at value at that point of time, right? It is more on sentiment at that point of time. So we are very careful with where we deploy money today. Large caps are looking a little bit relatively better than small or mid today. That's where you would see your solitaire position yourselves more today. And what the portfolio would look like after a few years is you'll have a few big winners, definitely. The reason why you will have a few big winners is that you can see in those quadrants that we spoke about, right? The few big winners were actually the multiple, I mean, they actually belong to this optimum performers bucket, which will eventually become few big winners, right? So if you look at the second quadrant that we spoke about, a company where we started off buying for all our clients right from the beginning, right? 2019 September was when we started off buying that company, and we bought it until 2022. But it started rewarding us in 2023 only, right? For those kind of companies, they would pretty much be multiple optimum performers. You would categorize them as multiple optimum performers only in 2022 or 2023. But when the up move happens, right, they turn out to become few big winners just because of your conviction in that specific stock and the way they've delivered in terms of performance once again. I mean, again and again, they keep delivering on their performance. Your optimum performers become your few big winners. But then our intention is to find these multiple optimum performers. Out of these multiple performers, you definitely will have few big winners and definitely will have a few losers as well. That's where you need to look at. That's how you need to look at solitaire because these few losers is something that you cannot typically avoid as a portfolio manager because globally, if you look at portfolio management, the best portfolio managers get 6 out of 7. I mean, 6 or 7 ideas out of 10, right? We've been lucky enough to get a few a number which is a little bit bigger than that, right? Most of our ideas have delivered well, but the thing is, we always need to keep our expectations on a decent level over a period of time. What we need to perform, how your solitaire portfolio intends to, what kind of returns your solitaire portfolio intends to give is something that you need to be very, very cognizant of. And the current positioning of Solitaire is pretty simple. The first picture is something that we show in every presentation of ours, right? It's the financialization of story of India, where you can see the deity or God himself or the goddess herself uh, getting money through digital payment, right? The hundi system has been taken away, and digital money is what God accepts. Even I mean, in a country like India today, where Indian traditions have been with us for a very, very long time. You can see this happening. You can see that this financialization story is still working, right? The inclusion of financial inclusion of every other person, every other citizen of India is happening. You can see that happening. And this we intend to capture with these efficient players who are becoming world champions, right? If you look at our specific small cap companies that we buy in our solitaire portfolio, you can look at these players being very efficient in their own game. They would probably operate within a very, very niche segment, and they would become and they would already be world leaders in their respective segment, albeit a very, very small segment, right? But whether they the bet on these companies is that they will become world champions in the future because they invest in capabilities today. These are companies that invest heavily into capabilities. They heavily invest heavily into becoming more efficient today, which will eventually lead them to become world champions in the future. And obviously, make in India is something that we're very, very upbeat about. This, all these three is what is going to show up in your solitaire portfolio in terms of different stocks. And our risk positioning, our expectation is between 700 to 900 bips plus the average inflation. Our expectation in terms of, or rather, your risk appetite could be somewhere between conservative to moderate in terms of solitaire, because solitaire has always reiterated that it's more of a risk adjusted portfolio or a risk adjusted experience that you've given, that we tend to give with your portfolio. The performance is a consequence of that process, is what we strongly believe. And just to give a very short conclusion of what we've been speaking about on the Indian economy, the prospects are good. Corporate India long-term prospects are good. Valuations is something that we need to be very, very cognizant of today because it's fair or attractive in select pockets only. So when we invest today, we need to be very careful. We need to be very selective about investing into companies which are attractive in terms of valuations, or because attractive valuations is something that you cannot really find today. But fair to attractive is something that we typically see today, and that's where we intend to deploy your money. Even in this 35% that we invest today, right, it's going to be into pockets that is fair or attractive. And our performance numbers since inception, you can see that we've done well, right? Again, what we would like to reiterate is that this performance has come at the win in the case of bull markets at their peak, right? It's a consequence of a process, that is one thing, definitely. But then we would like to anchor our expectations between our investors' expectations between 700 bips to 900 bips over and above an average inflation rate, which is probably between 6 to 7%. So a typical 14 to 15% expectation post fees and charges is what Solitaire intends to give for its investors. Anything above that is going to be a bonus for Solitaire and for the investor, is what we keep repeating once again. And all this would not be possible without a very robust team, right? It's we keep saying it's not our intelligence, it's not our investing prowess that has gotten us this returns. It's us effectively able to work as a team and our process, and us sticking to our process that has actually made this performance possible. Because without process, you do not know where your because even if we have a return which is one of the top, I mean, which has outperformed the major indices in a very significant way. It has to have a meaning to it, right? Why? How have these returns come? It's not because that our investing prowess. It's not because of how we selected stocks which no one else selected. It's because we worked as a team, and our process is very robust from right from the top to the bottom, right? We have Mr. Shyam, who's at the top, as you would all know, and a very, very strong fund management team with Mr. Balaji, Rohit, Rajat, and Ranjan handling their respective products, and a very strong research and strategy team with investment management and product management handled by all. So it's a team which doesn't really go away from the process, right? Once we stick to a process, we intend to stick to that process despite a lot of noise coming around. General equity market tendency is to go towards noise, right? Because what we see repeatedly again and again in the market is that people are drawn towards noise, but we would want to avoid the noise, stick in our own comfort levels, and do investing like we've always known it. That's what has typically gotten us to our performance as of today. And fund manager's profile, as you would know, Mr. Sham, he has over 3 decades of experience. It's his philosophy that is flown down to us as an institution. And we keep saying this, right? It's an institution that is actually building your portfolio today. And it's Sham's philosophy which is flown down to his institution today in the form of iThought. And iThought is what is doing or creating or maintaining or curating your portfolio today, right? It's iThought which is doing all that. And obviously, all credits to Mr. Sham for his philosophy, which has come down to in the form of an institution. The key terms for Solitaire, it's minimum investment as per SEBI regulations is 50 lakhs, where our benchmark is as per SEBI regulations as well. There's an exit load for 3 years. The intention of the exit load is to actually ensure that most of them, when people come into the markets, when if people had come into the markets in 2020 or 2021 or 2023, right, their expectation on returns has been very, or rather their expectation on how these returns need to be delivered immediately has gone a little bit skewed towards, or rather their expectation is between 1 to 2 years, right? That's not something that we would want our investors to keep in mind. They have to have a mindset of at least 3 years. And right, because markets tend to work in those cycles, right? You don't tend to make money in the market in the first year that you enter unless you're very lucky, right? So to see a cycle, you have to be in the equity markets for at least 3 years, and to actually realize from the client's perspective, right, out for the client's benefit, they have to be at least for a period of 3 years, which is why the exit load has been maintained. And it's a fixed fee approach, is a no nonsense approach of 1.5% on the average value of your portfolio charged on a quarterly basis. Right. So just a couple of seconds before we move on to the next slide so that you can take this into consideration. And just a small disclaimer that all information on this presentation are purely educational in nature. There's no intention to give any financial advice or suggestion on any individual stocks. So thank you all. Thank you for all for your patience. Now let's move on to the question and answer round. Okay. I think that there are a few questions already. The first question from Mr. KV Ramani. Good afternoon. How many stocks are held in solitaire for an average individual investor? So for an average individual investor, the portfolio would consist of around 25 to 30 stocks on an average, right? That's what we tend to do. Because today the overall portfolios put together, it comes to around 38. It's because of stocks of investors coming in to solitaire at different points of time. So I mean, we usually say, right, we don't go for a model portfolio approach. There's no model portfolio approach in our system. It's going to be extremely customized as to your entry point. Whenever you enter, we are going to customize the portfolio, curate a portfolio to your based on the entry point of each investor, and then we gradually build that portfolio over a period of time to make returns. Right? That's what typically Solitaire does. So even if the portfolio number of stocks today, on an average, if you put in total, is around 38, your portfolio will end up with between 25 to 30 stocks, plus or minus 1 or 2 stocks probably, right? That's the expectation. But our endeavor is not to sell a winning stock for buying another stock. That is the intention. So this is where our additional request for capital will also keep coming to you. So since once we build your portfolio today, right? Once we build a portfolio over a period of time, market may throw other opportunities as well, but we would not want to compromise an existing winning idea for a new idea in your portfolio. So at that point of time, your advisor or your relationship manager will get in contact, get in touch with you to let you know that there is there is a requirement for additional capital in your portfolio. If you're interested, then you can definitely participate. If not, the opportunities are going to keep coming, and we will, as advisors, it is our duty to come and tell you that there is an opportunity. So that will keep happening, and the portfolio building will happen. So it'll be a symbiotic relationship, right? It'll happen with the investor and the portfolio manager's interests, because both of our interests are aligned together. The activity is also going to be a very, very interactive activity, right? That's how it is. So, how many solitaire? What is your expected inflation level for 2024-25? Inflation level is something that we will not be able to exactly give out. So that is not something which is in our control. So we may not be able to give out a number on that. What is your view on railway and defense stocks on 2024 or 25? We usually refrain from taking any thematic or stock specific or sector specific questions, sir. So question from Mr. Dinakar Babu: stocks which are buying through this PMS will be in our demat account or I thought portfolio. Can we also track it to time to time about its performance? Yes, sir. So in this case, so let's say you start Solitaire with us. What we would do is we create a Demat account for you in your with our custodian, which is HDFC Bank. Let's say you Solitaire, you want to start tomorrow. You open a HDFC Bank Demat account in your name, so it'll be under your bank. So through NSDL, you'll be able to track the stocks that we are buying on your behalf. So it'll be an agreement between I Thought Financial Consulting and Mr. Dinakar Babu that I thought financial consulting will take over the activities for the Nagar Babu's Demat account, which is this, and this. So you'll be still able to track it in your recast statement and your NSDL, which will show you the stocks that we have bought for you as part of your Demat account that you opened with Solitaire. Hope that answers your question, sir. Question from Mr. Purushottam. Hi Ganesh, when you say invest in debt-free companies, does it mean zero debt companies or below one? It is typically when we say debt-free, it's completely net debt-free. So let's say a company can have 100 crores of cash and let's say 10 crores of long-term debt for whatever reason, right? Those are typically net debt-free companies because they are cash rich, right? They don't need to rely on debt for their operation except for maybe short-term borrowings, right? In those cases, it's all completely zero debt companies, right? And even if you consider companies which are, so we've said, right, 83% are debt free. These are companies which have no debt, absolutely no debt in their books. The remaining 17% are companies also with low debt, or rather, these companies are predominantly one which have a debt equity ratio of below one. When you say it's below one, I assume that it's a debt equity ratio that you are referring to. So even in that 17%, we typically hold companies which have a debt equity ratio below one. So it's predominantly a debt-free portfolio that you would be getting with Solitaire. Hope that answers your question, sir. Question from Mr. Sarat Kumar. Is Mr. Shah Mudalitikalam is the CEO for the organization? What is the difference between his boring stocks free suggestion in his YouTube channel and the suggestion provided by Solitaire? Please elaborate how this paid service and how much is the expense ratio. Please let us know about the cost for this service. So first, we would want to reiterate. Mr. Sham is the CIO of the organization. He is the chief investment officer of the organization. The boring stock portfolio is not a suggestion that he gives on Mudali Kalam. It is more of a representation of what he thinks are boring stocks, which are considered boring stocks by the general public. So there is no suggestion, there is no advice for any of the viewers or any of Solitaires or I Thought PMS's viewers to buy any specific stocks of this boring stocks portfolio. So it is just more of an exercise that is run by Mr. Sham out of educational I mean, it's on educational interest that this boring stock series is being run, right? It's not for any suggestion or any advice or any matter. In that case, there is no, I mean, in Solitaire, with respect to Solitaire, it's a SEBI-registered portfolio management service, which is intended to address the requirements of retail, I mean, multiple investors, right? So if you are interested in Solitaire, you would have to sign an agreement with us and as the on the expense ratio, it's 1.5% on the daily average value, as we had mentioned in the key terms. For any further details, you can reach out to us through our email ID or phone number. We can have one of our representatives reach out to you. Tarun, if you could message on the chat box the contact number and the email ID, we can have Mr. Sarat Kumar reach out to us, and one of us will get in touch with him to take this further. But as far as the Mudali Kalam boring stock series is concerned, it has nothing to do with what I thought does. Boring stock also is not a suggestion of any form. It is more of a series that is being run, which is purely out of educational interest. Hope that answers your question, sir. So it's like POA from Mr. Dinakar Babu. Yes, sir, exactly. It's like a power of attorney that you give I thought Financial Consulting LLP to carry out your transactions on your behalf. That's how it is. Thank you, Mr. Kotin Purushottam. Thank you. Question from Mr. Gopi Pakisami. What if I already have a Demat account in Zerodha? Should you ask me to create another one in HDFC Securities? Yes, sir. So it's not with HDFC Securities. This Demat account will be created with HDFC Bank. HDFC Securities is a trading plus, it's a trading platform essentially. HDFC Bank is where we would be creating your Demat account, and this Demat account will be linked to our existing PMS client accounts so that we place an order today, it will end up in your demat account by the end of the day. So it's a pooled account. We operate on a pool account basis where we place trades for all our investors, and these trades, once they get executed, they end up as securities in their respective demat accounts, which are in agreement with Solitaire, right? So today we sign an agreement with you. What happens is we open this demat account, which is linked to our PMS list of accounts. So this should be an entirely new account that we create with HDFC Bank. And once these trades are placed, they end up as securities in that relevant demat account, which we will have complete control over until the uh, until the agreement is in force. So once you have an agreement with iThought Financial Consulting about the demat account, until then the demat account will be in our control because it's a completely discretionary portfolio management service, where the decisions on buy or sell is taken by the fund manager. Question from Mr. Narasimhamurthy. Hi, good afternoon. What is the reason for not including any banking stocks in Solitaire portfolio of stocks? Okay, so that's a very interesting question. So thank you for this. The thing is, if you look at any portfolio which is typically a flexi cap or a multi cap portfolio in the country, right? What you would end up seeing is that they're very, very heavy on banking or lending, right? And there's a reason for that also. It's because they have a inherent requirement to be beating the indexes and beating the indices, right? If you look at any major index in India, let's take NSE 500, BSE 500, Nifty 50, whatever, right? If you look at a flexi cap or a large cap index in India, you will typically have a very, very huge banking exposure. So if I'm a mutual fund or if I'm a fund which is operating in the flexi cap space, if I do not have a good amount of banking stocks in my portfolio, I wouldn't be able to. I wouldn't have the leeway. So it's like I want to compete against the index. I want to go above the index or rather perform above the index. That is the requirement for most mutual funds, right? That's the mandate, and all their salaries or all their incentives are linked to this outperformance, right? So they have this inherent requirement to outperform the major indices. So in our case, there is no such requirement, right? For us, I don't need to have banking in our portfolio because it's going to be a complementary portfolio to any other portfolio that you see in India. So you take any portfolio that you already are buying, let's say through a mutual fund or any other fund manager, right? That you typically have, which is a flexi cap, you will have a heavy allocation to banking. So as investors in India, we are already very, very skewed towards our allocation to banking. So if Solitaire comes today with again a banking exposure to it, you will end up getting the same type of stocks where you can actually play around, let's say 30% or 20% of your portfolio is banking. It's only this 70 or 80% that you typically have at your disposal to play around with other stocks, right? We do not want that kind of a restriction, or rather we do not want to play that kind of a game because we are not running against anyone. We want to create a portfolio which is a complementary portfolio to every other portfolio in India, which is typically banking or lending heavy. That is the reason that we do not have banking or lending exposure in Solitaire. It is going to be a portfolio that addresses your concerns on a risk adjusted basis. That is, if you are owning a portfolio in India, you will definitely have to be owning a banking heavy portfolio in India. And this is something which is done exceedingly well without banking exposure in India. And we've done that in the past. The expectation is to do that in the future as well. That is the reason why we do not have banking exposure in our portfolio. So hope that answers your question. Thank you, Tarun. For everyone's attention, we have put our contact details on this chat box. You can take note of this, and if you are interested, if you have further questions, you have further queries, if you want more information on Solitaire or any of our products, right, you can reach out to us through our contact number or through our email ID. Thank you. Question from Mr. Dinakar Babu. In what way is this different from mutual funds? Because when you mention moderate risk designed in Solitaire, so it's kind of a balanced advantage mutual fund with multi-asset. Okay. So when we say moderate, right, it depends on, it doesn't mean, so just to make it very clear, it's Solitaire is a multi-cap, so it's a flexi cap, right? It's a flexi cap approach where we buy large caps, mid caps, and small caps. So it's not multi-asset. We do have a multi-asset fund called Sphere, right? But Solitaire is pretty much Solitaire is 100% equity stocks only. When we say moderate risk, right, what we tend to say is the forthcoming slides would have told you that we don't typically get into companies with high risk ratios or with over leveraged risk ratios or liquidity concerns or companies which have a lot of things on their plate. So typically it avoids risk by avoiding these companies, avoiding, let's say, value traps, or let's say avoiding companies which are very ambitious in nature, right? But somehow we also have allocations to companies which are ambitious, but then we measure our deployment in such a way that we do not go overboard with that. So you will typically find that Solitaire has its intended allocation between 3% on 3% to 5% only. We restrict or we manage risk in those aspects, right? We do not we do not manage it by adding more assets to our existing portfolio. It's going to be 100% completely equity. But then how do I manage risk within 100% equity product is I do not get into, or I try to avoid mistakes more than trying to hit a sixer with every other ball. That is the intention of Solitaire, and it has worked out well for us in the past. Right? So it's not a balanced advantage fund. It is more of an equity fund with, which is why we say there's no other fund like Solitaire in the country, because we do not buy banking, we do not buy lending, we do not. It's very risk adjusted, and it has a portfolio beta of 0.75, so it's a one of a kind of a fund, right? So it is typically an equity fund which will deliver 700 to 900 basis points, or expected to deliver 700 to 900 basis points above the average inflation rate. So when you ask us how it is different from mutual funds, the inherent structure of a PMS itself is very different from mutual funds, sir. So mutual funds work like you pool in a set of funds and then you keep investing. So you have to buy stocks at different prices, or rather same set of stocks for different investors at different points of time. So they do not get the valuation comfort that we would tend to achieve with Solitaire, right? Today, we may go only 35% with 35% of deployment. Tomorrow, if things change, right? If valuations become more supportive, we can go with 70% also. The kind of flexibility that a PMS gives over mutual funds is exactly that, right? Most PMSs, when they get bigger, they tend to operate a model portfolio approach where they end up buying the same set of stocks again and again for a multiple set of investors. But in our case, we have made it very clear right from the beginning that we are never going to go towards this model for portfolio approach, because it's kind of a disservice that we provide for a client for either being early or late to the game, right? So our intention is to give a very relatively a good enough homogeneous experience to all our investors. So in that case, your PMS as a structure will be absolutely utilized only if you do a non-model portfolio approach, because otherwise, you're just buying a mutual fund if you buy a PMS which buys 90-95% on day one, unless the valuations are very lucrative, right? If a PMS buys 90-95% on day one for your portfolio, it is no different from a mutual fund. So that's how PMS works, and we typically want to use that flexibility to the client's advantage. That's the intention. Question from Mr. Arun, high in fee section other than 1.5% mentioned, all other fee at actuals. Please elaborate. Sure. Sir, if you look at other expenses like brokerage or so we are portfolio managers, right? We have to execute transactions through on your behalf through a broker. So for a broker, for each transaction, there is a brokerage fee. For us, it's typically around 0.1% of the traded value, which will so if you look at other actuals, right, it will come to around 0.25 to 0.3% on the overall AUM, right? That is what is typical. I mean, it's on the actuals, but then if you look at our history, or if you look at it on an overall basis, it will somewhere lie between 0.25 to 0.3, because we are going to practice a low churn portfolio. Our portfolio is not going to have a lot of buy and sell trades, right? It's going to be mostly a boring portfolio. The intention is to hold for a good amount of time. So the other fee would, if you look at the number, if you're looking for a number, it will be between 0.25 to 0.3. Hope that answers your question, sir. Hi Ganesh, what will be the DMAT fees via HDFC? DMAT fees, so typically, if you look at it's all on actuals, Mr. Kiran. So if you look at the previous answer that I gave, it's around 0.25 to zero point 0.3. So this 1.5% will be the fees that you pay Solitaire for its which is the fixed management fee that you pay for the fund management part. and other fees would be 0.25 to 0.3%, which will somewhere, which is what you typically incur if you hold a demat account, and the normal fees that you see with your retail accounts as well. So that's where your overall expense will come to 0.25 to zero point 0.3. That will be the total expense, which includes the demat fees, which includes brokerage, which includes other custodian charges, which includes audit charges. All that will come under this 0.25 to zero point 0.3. Hope that answers your question. Okay, question from Mr. Arun. Please mention the difference between Solitaire, True Blue, Vriddhi, and Sphere. So, okay, Solitaire, to give a very brief understanding, right? We've created our universe in such a way that we are able to provide a product to every type of investor, right? So Solitaire addresses a wide set of investors because it gives a good balance between stability and aggression, right? True Blue, it's a conservative approach with just large caps. So it's actually a very concentrated large cap approach, which has a lot of which has a potential to be aggressive also when the valuations are in favor, right? It's 100% large cap. While Vriddhi, it's the most aggressive product in our platform, which is small and micro. Sphere, again, it's a multi-asset approach, which where we buy mutual funds, where we buy ETFs, where we buy stocks, where we buy global funds, where we buy gold, silver. So it's a multi-asset approach that we follow with Sphere. So if you look at our products, they're very, very distinct from each other, and then they serve uh, their respective investors' interests very, very clearly, right? So a solitaire investor would ideally be a person looking for a moderate risk-taking approach to get a good balance. True Blue is somewhere between someone wants to park their retirement money in a very suitable fund, which gives you which is expected to give better returns than a fixed instrument like an FD, right? Vriddhi, again, it's as it suggests, it's a very aggressive product. It's small and micro, so that requires a specific thinking. Again, Sphere, which is similar to True Blue in terms of what it tries to address, your retirement money is what in a relatively less volatile product is what you try to park. That's where you park it with True Blue or Sphere. That's what these two products are intended to do. Sphere does it with a multi-asset approach, while True Blue does it with a large cap blue chip approach. Hope that answers your question, sir. Question from Mr. Sarat Kumar. How many times in a year will rebalancing be done by your team? SIP mode is available or only lump sum investment is via Solitaire? So there's no rebalancing essentially. This is where we differ, sir, right? Okay, so let's say you start with Solitaire today. Okay, to answer the second part of your question, SIP mode is not if your intent, if you're referring to the SIP mode to start with this 50 lakhs, right? That will not be possible, sir, because SEBI regulations mandate that only if an investor starts with the lump sum of 50 lakhs, he will be able to buy stocks on their behalf. Otherwise, it is against SEBI regulation. So as per SEBI regulations, you are intended to start with this 50 lakhs, which is a lump sum. Beyond that, your SIPs can start off over and above this initial 50 lakhs lump sum. And to answer the first part of your question, the rebalancing, that's not something that we do. Or rather, how it works is once you start with a 50 lakh portfolio, tomorrow there's an opportunity that comes and then you add some more money, right? We don't rebalance the entire portfolio by adding this additional money across all stocks. So let's say you start today and over a period of time, we buy 25 to 30 stocks on your portfolio. Tomorrow you add another 10%. What happens is in this 10% that you add is bought over a set of two, three ideas or four ideas, depending on when you add that 10%, right? Because for us to, because each capital, whether it's a lump sum or an SIP, right? Every other small or big capital is very important. And from a client's perspective, we would want to do the right thing, right? We can't buy a name which has already gone up. So let's say 1 year, after 1 year, you're adding 10%, right? Let's assume. At that point of time, a lot of stocks would have gone up. Certain stocks would have come into the spotlight, and we would want to buy those stocks because they're offering a good entry valuation today. So, depending on all that, your addition will be done at that point of time, and just blind rebalancing won't be done when you add a capital. So, hope that answers your question. So, this is where we typically differ from the industry, where the industry typically wants to buy a model portfolio once and again and again and again for different investors. We do not want to resort to that approach because we are very, very strict with respect to value, and we believe value can be achieved only if you are very specific about your buying and not just very broad based. Hope that answers your question. Question from Mr. Dinakar Babu. What's the absolute returns and analyzed returns since inception till date? We went through the returns, sir. Let me just go back to that page so that can yeah. So you can see our returns since inception and at different points of time. Uh, Hope that gives you a good idea of what we've done till till now since our inception. Question from Mr. Purushottam. Hi Ganesh, in the current market scenario, do you see value in sector wise or which sector are worthy to accumulate? Uh, we've always been bottom up with respect to our investing, right? So we've when okay, just to give you an example, in 2023, I think closer to the end of 2023 is when IT stocks performed, but then we were able to figure out, or rather, we were able to get into an IT stock in the specific segment where most of the IT stocks didn't do well. The stock tends to do well because these kind of stocks, right? They chart their own territory. They chart their own journey. So even in a scenario or a market scenario where unless the market or unless the industry is very overvalued on the whole, right? You wouldn't get a pick. But then even in troubled scenario, even in sectors which are going through troubled times, right? In our experience, we will be able to find out stocks or businesses which will tend to do better or tend to move in a different direction when compared to the rest of the industry. So our investing is sector agnostic. So though we are not very particular or we are not fixated to one sector as such. So when we add today, right, we are looking at sectors which have kind of been ignored by the market in the last couple of years. Let's just for an example, the insurance sector is something that we are very positive about today. And you can see a good amount of Solitaire's initial deployment going towards that sector as well. So that's where we see, though we are not value specific in terms of sectors, it is going to be stock specific. Though we have a good vigil on the overall sector outlook with respect to different sectors, we go stock specific and bottom up with respect to our investing. So hope that answers your question, sir. Question from Mr. Dinakar Babu. Could you please share this recorded session to our mail? It will be helpful to listen fully to those joined in the middle of the session. Absolutely, sir. Absolutely. If you could just uh, respond, and if you have registered with your mail, right, we can get one of our representatives to share this recording with you. And I think if it's recorded on YouTube Live, also we'll ask them to send a link so that you can directly watch it on YouTube. Question from Mr. KV Ramani on your 1.5% fee. GST also is to be paid by the investors. Yes, sir. Okay. To give a very broad idea of, since there have been many questions on the additional charges on GST and all that, let me give a very clear explanation of how the charges will work. Right. This 1.5% will carry a GST fee of 18%. Right. 18% of 1.5% will be 0.27. Right. So 1.5 plus 0.27, 1.77 will be the fee that is paid to ithoughtpms. Out of this 1.77, 0.27 is paid to the government by ithought, right? So 1.77, 1.5 is retained by us, which is our management fee. 0.27 is paid by ithought to the government, which is collected from the investors as GST. This is one part of it. Other than that, you will have other charges like I had explained your DMAT charges, brokerage, and all that, which would come to around 0.25 to 0.3%. So overall, if you typically look at it'll somewhere lie between your overall gross cash flow for as expense will lie somewhere between 2.1 to 2.15%, which is the bifurcation is 1.5% of uh, management fees paid to I thought, 0.27 paid to the government, and 0.25 to 0.3 paid to the respective vendors like HDFC or the trading broker that we have. And so on, right? So overall gross total expense will be 2.1 to 2.15% essentially, right? And if you look at our returns that we show on our performance sheets or our presentation, everything is net of all fees and all charges. So it includes all these 1.5% fees, this additional GST expense, and your other charges that is to be paid to the other vendors also. So it's the net returns that an investor would have got over a period of time after all these fees and charges. Thank you, Arun. Question from Mr. Sarat Kumar. How minimum investment as lump sum itself 50 lakhs. Yes, sir. The minimum investment would be 50 lakhs as mandated by SEBI. So we're SEBI registered portfolio management service providers. So the minimum investment as mandated by SEBI is INR 50 lakhs. Hope that answered your question. Question from Mr. Arun. Hi, is there any access to view our portfolio once joined in Solitaire, like online site access or app login to see the portfolio? Yes, sir. So, since this Demat account is going to be created in your name, right? NSDL is a portal where you'll be able to see your portfolio on a daily basis. And NSDL is where your Demat account will be created, and using your depository participant ID and your client ID, you'll be able to create an account for yourself. And I think NSDL has an app as well where you can see track your portfolio on a daily basis. Hope that answers your question, sir. Fees and charges are applicable only for invested in equity, or charges are applicable included cash component that are parked aside as well. Yes, sir, it is including all that only because the fees and charges is on the portfolio, right? So, okay, this is a question that we had recently got also from another investor of ours. The thing is, it is exactly so. Let's say today we are deploying 35% and keep 65% as cash. The 65% cash is not idle money. The 65% cash is part of the strategy to keep as dry powder, all from the investor's interest. When the opportunity comes, the 65% will be invested. So it's not because there's no activity that is required to be done for this 65%, but it is from the investor's interest in terms of valuations that we keep the 65% as dry powder to be invested when the opportunities come. So it's on the overall portfolio value and not just the equity component that these fees and charges will be applicable. Hope that answers your question, sir. Thank you, sir. Next question from Mr. Arun. Cash portion will be in the account ideally, or will you park in a debt MF like that? Yes, that's a good question, sir. So when we start off Solitaire for you, let's say we start off Solitaire for you today, right? 35% will be deployed in equity. 65% will be bifurcated between liquid funds and cash. This, let's say 10% today will be cash, right? Cash will be held in the current account, pool account, which will be used in case an opportunity comes up within within the day itself, right? See, let's say we park it in a liquid fund, and there's an opportunity that comes after the market opens, right? Let's say 12:30, 1:30. At that point of time, requirement of cash would be required from the investor's interest to be deployed into a specific stock, let's say is giving an opportunity after 12:30. At that point of time, we would need that cash, right? So ideally around 10 to 15% will be kept in cash, and 35% today it will be deployed. The remaining 50% will be into liquid funds, which typically yield between 5.5 to 6%. That's the intention, that so it won't be left aside as idle money is what we're trying to say. Hope that answers your question. Question from Mr. KV Ramani. How often are the webinars held? The webinars are, we hold webinars every week. So every week, every Saturday, we have different webinars. We have different products, right? So one week we can have a Solitaire webinar. The next week we could have a Vriddhi webinar. So we keep getting these webinars scheduled every week, depending on the presenters' availability and the requests from our investors as well. And it could be a client specific webinar, it could be a general webinar for the public. So we are very active with our webinar. So you can follow our LinkedIn or our Twitter page of ithoughtpms. Tarun, if you could give out the links of our LinkedIn and our Twitter pages on the chat box, it will help our viewers access this and join the webinars whenever we post about these on the group. Hope that
Sure,
answers
sir.
your
Sure, sir.
questions. Thank you, Tarun. Next question would be, which state would you ask to top up the portfolio once all the initial investment amount has been consumed, or you will ask additional fund when you already have some dry fund as cash as well? What is the strategy? It will be only when we run out of cash, sir. Right? So, okay, today we've also been urging our investors to start an SIP kind of a structure. Why? Because see, usually SIPs are very effective tools, right? Why? Because let's say you start with a 50 lakh portfolio today and start by giving us 1 lakh every month, right? So once at one point of time, this 1 lakh is not going to be used as long. This 1 lakh is not going to be used immediately as soon as you transfer, because initial investment of 50 lakhs itself is going to be invested on a gradual basis. This 1 lakh will keep getting accumulated. But why this 1 lakh is something that we suggest to all our investors? Because it builds a behavior of you. I mean, it builds a behavior in the investor to invest on a regular basis. And since you have a portfolio manager which like us, who does not invest into stocks just blindly, right? It doesn't We do not invest into the entire set of stocks again and again with any additional, because that is just going to dilute your experience and the returns. The intention is to buy right and buy specific, right? So even if you add this 1 lakh, what is going to happen is your decision making is done at that point of time itself. You don't need to wait for this additional capital requirement when it comes later. So the opportunity will be communicated by the advisor either way when the cash runs out in your portfolio. But let's say you do an SIP, it is going to be easier for it is going to be much more efficient for the fund manager to deploy your money when the opportunities come, because opportunities can come any day. So at one point of time, you will see that the amount is being deployed, or rather the deployment going from 35% to 70% or 75%. So at that point of time, the remaining money also can get used up pretty fastly, right? So when you have inculcate a behavior like an SIP, what happens is it hits the investor's account on a monthly basis, and the fund manager also has enough cash to deploy when the opportunities come. And depending on the opportunity at that point of time, only we will invest. If not, it's just going to be this dry powder strategy that we follow until the opportunities present to themselves. So to just simply answer your question, it is going to be requested only when there is a requirement on your specific funds, because we have our advisors have portfolios of different clients of theirs, so they will have different cash levels. They will have different requirements, because your portfolio will be entirely different from another investor who onboarded with us 1 2 years back, right? So his cash level might be totally different from yours. It so tomorrow the advisor wants to talk to you. He will going to address your portfolio and then only talk to you. He's going to see how much cash is left in your portfolio. He is going to consider what the fund management team has requested in terms of additional cash on your portfolio, and then only ask you for additional capital, and not before that. So if you have an existing cash level of 20 lakhs, the advisor is not going to call you up and ask you for more capital, because that is already available for the fund manager to add when the opportunities come. Hope that answers your questions. Question from Mr. KV Ramani. So the 3-year lock-in will be applicable for the SIP amount also based on the date of investment? No, sir. So the 3-year lock-in period will be from the initial investment date only. So let's say you start today, this 3-year will be applicable till let's say till April 25th or 27th only. So this April 2027 only. That is sorry, Jan 2027 only. That's how this 3-year lock-in will be applicable for if you start. So it's based on the initial investment and not on the SIP amount. That's what we're trying to say. So even if you add an SIP amount 3 years later, there's no login for that. You may immediately add it and immediately redeem it also. There's not going to be a problem. It depends on the initial date of investment. That's all. Hope that answers your question, sir. Is there any practice of sharing the portfolio performance with the clients? If yes, what is the frequency? Yes, we share the monthly reports with our clients, with all our clients. So our reports sharing frequencies on a monthly basis, where it will have a comprehensive set of reports which has your performance, it has your portfolio, it has your capital gain statement, it has your dividend statement, it has your transaction statement, it has your bank statement. So it's a complete set of reports which gives you a complete overview of what has happened in your portfolio between that period for that month, right? So that's something that will be sent within 5 to 7 working days or after the end of the month to your registered email ID. That's the frequency. Hope that answers your question. Question would be your research team can study and sense if there is an opportunity going to come in advance and inform the investors in advance to invest in additional cash or to top up the portfolio, or will it be like reactive mode, like once the market is in correction, then your team approaches the investor to additional cash? How that works? Okay, that's a good question. The thing is, we need to first accept that we can't exactly read the markets, right? And we need to also accept the fact that we won't be able to catch the market at its absolute bottom or sell at the absolute top, right? That usually doesn't work because obviously, even if you are the best investor in India, or rather, investors in India know the fact that they cannot catch the top or the bottom, which is why they're the best investors, which is why they don't try to time the market, and that's the reason why they are where they are today, right? So we will not be able to sense an opportunity which is going to come in advance, right? But then let's say there is a stock which is there's an idea which we would like to buy, but it is not to our buying range, but it has come down to our come down close to our buying range today, right? Then we would let our investors know at that point of time because to be very honest, not every investor can react very quickly, right? It's not like I ask you for money and then you immediately add to your portfolio because we will have our own requirements. You'll have your own liquidity issues, or it's not like everyone will have money at any point of time. So we do not place our investors in such situations, so they will have a good amount of time which they will get to add this additional capital that we request on their portfolios. So once but the thing is, these opportunities are going to keep coming, right? It's not going to keep, and these opportunities are mostly not going to go away immediately, right? See, today markets have become very efficient, right? They tend to reward and punish very, very quickly. But this all can be a little bit different later also, where markets move sideways, right? You'll have opportunities throughout the year, so you will have enough time to add on to these opportunities. So there's no uh, there's no urgency on the investor's part or the portfolio manager's part to keep adding again and again, unless the potential opportunity is very huge. At that point of time, the gravity of the situation will be definitely communicated by the advisor to user. So the request will come in the form of explaining how important this additional capital is going to be. The advisor will come and tell you, let's say a situation like March 2020 comes, the advisor should have pushed the investor to a point where they needed to add at that point of time because of the inherent opportunity that was available at that point of time, right? So that aggression you will see from us, our interactions, you will see that aggression or that softness from our request at that point of time. So depending on that, you can be adding, and depending on your availability of liquidity, you can add. So at that point of time, we will give that importance of how important it is to add. Or if at that point of time you do not have liquidity, your opportunities are going to keep coming. You can definitely add later as well. But as advisors, it's our duty to come and tell you that there is an opportunity. So that will keep happening. Hope that answers your question, sir. Question from Mr. Okay, please share video link to my email as well. Sure, Mr. Arun. If you can, okay, if uh, you can share your email ID over here, sir. I'm not sure if it's in the registration box. If just to be clear that this is your email ID, if you could put it in the chat box, we will ensure that we send it out to your email ID as well. Thank you. In Solitaire, assuming there are around 100 customers enrolled from inception to today, and you also mentioned that each portfolio will have a separate equity list, may vary between 30 to 40. How you're overall calculating overall Solitaire performance? For example, if customer enrolled in inception may have a stock, for example, Maruti, and new customer enrolled in Jan 2 may have now that stock, then how the performance is calculated under one portfolio under Solitaire? So this performance that you see is the average of all portfolios in Solitaire since inception till now put together on an average, sir. So that's how. So let's say Solitaire is a one big fund, right? Let's assume that all portfolios is one portfolio. Solitaire is only one portfolio. Let's assume that, right? If all investors come in at different points of time, give cash at different points of time, uh, you that portfolio will end up with a performance, right? So that is what this performance is, right? As per regulations, we're supposed to disclose only this performance, which is the average of all investors' performance put together, because if specific performance is disclosed, it's as if it's the privacy. I mean, it's the private information of an investor, which is their performance, right from their inception till now. So we don't disclose that private investors' performance. And as per SEBI regulations, we are supposed to disclose this average performance of all portfolios put together that does come out in the screen for your viewing today. Hope that answers your question, sir. Thank you, sir. Thank you, sir. Okay, not fully convinced, but I have to accept. May I know where exactly you're not convinced with, sir, so that I can maybe elaborate a bit so that it's clear from both our perspectives. Thank you, Mr. Ravan. Thank you, sir. Thank you so much. Transparency of the portfolio percent and individual portfolio percent. So the thing is, see, there are restrictions, right? Right. If there are multiple portfolios, if there are multiple stocks, the reason why we have or rather ask for additional capital is for. So let's say you are a person who comes in, who came to Solitaire in 2019, right? And you still have the portfolio with us. For a person who comes in 2024, we may be buying an idea which is not part of your which is definitely won't be a part of your portfolio because it might be a new idea, right? It might be a new idea that we are buying for a new person, new investor today, which may not be a part of your portfolio, right? Agreed. So but the intention is to buy that idea also for you at that point of time. The request will go from that specific advisor for that specific client requesting for additional capital. So in the end, what we are trying to do is trying to give a very homogeneous experience for all our investors. But then in terms of returns, what you can ideally represent is only the average or the totality of all the investors' performance, right? Otherwise, what you end up doing is giving only the individual performance of each investor, which we are not allowed to do. So this is something that you have to look at on an overall level. So you can see the since inception returns will vary a lot for our investors, which I had said for our investors, around 50 investors who started off 3 years back, right? They were beaten the outperformed the benchmark by around 470 or 480 basis points. So those since inception returns will typically end up being higher than the since inception average return that you see, right? So it is actually both ways you'll have to take it, right? So certain investors, so most of us, our investors will be around this bracket, right? Since inception numbers for investors who started off in 2019 or 2020, it will be around this bucket. But most of them will have somewhere the numbers which are above this 27% number because most of our investors joined us after 2020 or 21 only. So their averages would have brought down their older portfolios average somehow. So all these misalignments would be there, but then in the end, what we can represent is only the average because that's what we are allowed to do, right? So hope that answers your question, sir. Thank you, sir. Thank you so much. Sure. Thank you. Any other questions? You can type them out in the chat box, and we've put out our contact details and our social media pages as well. Tarun, if you could put them out once again for our viewers' benefit,
Yes,
if you can put them out
sure,
once
sir.
again. Sure. Thank you, sir. Uh, Thank you all for joining us today. Hope we were able to answer all your questions. If there are any further, okay, thank you, thank you, sir. Hopefully, 1,000 crores is soon enough. Thank you so much. Thank you all. Thank you, Kiran. Uh, So we have our Twitter pages, the links of our Twitter page and our LinkedIn page and our contact details as well on the chat box. If you would like to know more about our product or you have any queries, you can always reach out to us and we'll get one of our representatives get in touch with you and take it forward. Thank you all for joining us today and hope you have a great Saturday evening. Thank you.